Welcome to the Salty Investors. This is episode number 11. And as usual, I'm joined by Tim. How are you this week, Tim?
Good, yourself?
Yeah, not too bad. Can't complain. But I will anyway, because as is custom, we've got to get to the salt. And my salt this week is the ever growing cacophony push for everything wonderful on the climate activist front. This week it is waiving fringe benefits tax for EV vehicles, which can save up to $30,000 over the lifetime of the vehicle. Of course, this is aimed at people who can afford EVs under the limit of the luxury tax car, which I think is $84,000. Over that, there's a luxury car tax, so that has to be under $84,000. So anyway, basically, you don't have to pay fringe benefits tax on it. That's worth about $500 a month or something.
Wow.
So, of course, this is an incentive for people that run car fleets, probably, government organizations to, go out and get EV car fleets. I suppose that means that, there's going to have to be all kinds of infrastructure built for that. This is not part of that costing, I don't think. And if you've got an employee, they've got to have a battery at home, or else there's not much point them driving a EV home. But anyway, again, my view is that if all this was so wonderful, you wouldn't need these incentives to begin with. But here we are.
Well, that's the way it goes, I suppose. They want to spend money, and top end of the town obviously does better than the bottom end of town. So
yeah, that's the other point. It doesn't. Most people can't afford a $70,000 EV, or they're not buying brand new EVs or leasing EVs at $70,000 a year. A lot of people are getting secondhand cars. A lot of people are getting lower cost new cars if they're getting a new car. But yes, this has always been an elitist enterprise, so it's no surprise. Yeah. What are you salty about this week, Tim?
You might have noticed Disney has had a change of leadership at the top.
Oh yeah, Bob is back.
Yeah, the
Bob's
other Bob,
back.
the old Bob, old Bob
Yep.
Iger's back. Just the board, decided to truck out the old Bob, which was endorsed by the old Bob, the new Bob.
Yeah.
Well, yes. And the board is sort of like throwing him under the bus, saying, we did all this stuff last minute. I'm a bit annoyed. It's a great brand. They've got a great enterprise here. Really strong brands. You think, is anybody going to take on Netflix? And I think these guys have got a case. If you've got kids, you're going to be going, well, I'd definitely be buying, Disney. Just they left it to the last minute. And the board was responsible for that. And especially Iger, he didn't get involved in streaming until it was, very clear that Netflix was going to win this. And now, the other Bob's just being kicked off the bus. And yes, he is an idiot, like this guy doesn't know what he's doing, but you can't all throw it at him. And I see the stock rallied 8%. Just on the news.
Yeah.
It's still got all these problems like negative cash flow, burning all this money on content. The park business isn't looking as good as it was. I can't solve these problems by just kicking one person out of the whole. So that's my salty bit. I think the board needs to take some responsibility here, and I just don't see it happening.
Yeah, what's that old Buffett saying that I'm about to murder? It's like when a CEO with a reputation for good business management meets a company with a reputation for bad economics, it's the company that usually wins out. It's just sort of like, this sort of delusion that Bob Iger can come in and turn the ship around. It's like, you might have left it in better hands if that was the case when you left.
Yeah, so that's all. I'm just thinking, the market's a bit delusional here, thinking it's all going to happen in the next couple of months. Iger's going to come back and save everybody, fix this balance sheet and, this cash flow problem that they've got. But, they're still woke as hell, Doesn't matter. They're not really looking after the core demographics. And they're trying to sell everything to everybody, trying to make adult content on the frickin' Disney Channel. Like, stick to what you're good at, fellas. Like,
you can own that kids market, which is a huge thing, for parents especially, Stick to that. And don't they have all the They have a couple of decent property. The Mandalorians are not bad property, and
ESPN. Yeah. So
yeah,
they've got
yeah.
the brands are just phenomenal.
Mm.
Like, it's just I just can't understand their strategy here. That's all. Like, I think I would have preferred they just sold some of it to Netflix, kept it low overhead, and that's hindsight. But yeah, I just left it a bit late here, I think. And
well, let's see if Bob can out Bob.
Yep.
Bob the old Bob.
Yeah, so I don't know, just a bit upset about the market as well, rallying 8% very hard, for a couple of days on just news.
Because you haven't bought any?
No, I haven't bought it, obviously, but it's corrected a little bit down, but still it's above $100. It was very close to $100 now when it was 90 before this. So yeah, we'll have to wait and see. There's no miracle workers here. You've still got a lot of heavy lifting to do. So
yeah, exactly. Yeah. All right. Well, in macro land last week in Australia, we had unemployment reports are extremely boring. They're a lagging indicator, as we've said before, but I bring this up to sort of highlight a bit of a conundrum that the RBA has got itself into. So it's sort of the verbiage out of the RBA lately is that we don't need to go too hard. We can wait and see. But you're about to get an inflation print at the end of this month. It's going to be in the 8s. You've got an employment market with a record low unemployment of 3.4% as of the last report, even though that's a lagging indicator. You had the Reserve Bank of New Zealand yesterday raised 75 basis points. So they've gone from 3.5 to 4.25, and they have the fastest cratering housing market in the world at the moment. And we're plodding along. I mean, I think right now there's about 2/3 of market participants think that, or it's about a 2/3 chance that we're going to go 25 basis points in December. The Fed is, pretty committed. So it's an interesting place to be. And I think maybe you want to comment on this, because I think you sent me an article yesterday about Philip Lowe talking tough on inflation, where his other reserve governors that we highlighted last week aren't taking a more dovish view. What's going on here? Is this usual RBA confusion or what?
I think they're just so far behind, and I think they should be doing a little bit more on the front end here while the economy is still good. I think they should be lifting a little bit higher, and since they've gone 25, it's just going to be very hard for them to do 50 now. And do we even have a meeting in January, or we're off?
I think
February?
we're off. I think December's the last one, and
so that's a bit of a gap here now. So and if it gets away in the beginning of the year, they'll be scrambling the front to next year, and if the economy's starting to slow down, then like these Fed rate hikes are into the system now, and they start to come through the economy, it's going to get hard to go do a 50 then. So that's what I'm just a bit worried, that he's just left it a bit too late here. That's all. So what do you think?
I think they're in a rock and a hard place that they've created that situation themselves, really. I mean, they are. I mean, I've said this before. I don't think the Australian economy can take too high interest rates just because of how leveraged to the housing sector we are, and variable rate mortgages. I mean, there's no way we could take 5% RBA, which sounds ridiculous in history, but it really is. I mean, that's the state of where we're at. So they must know that, but they also must know that cost of living is the biggest concern of Australians right now. I just read another survey today. 70% of Australians put that as the number one concern they have. It's ahead of climate change, and it's ahead of a treaty with Indigenous people and all these other so-called pressing issues. It's cost of living is the number one, and I think the Labor Party's had their sort of what would you call it, honeymoon period, and it just gets harder for them now because people this really gets to people. People see it, they notice it. It's not something creeps up on them. They notice it every time they go to the shop. So yeah, the RBA is in a tight spot, but it is a tight spot of their own making. They left it, they should have gone a lot earlier than they did. And yeah, and I just think maybe can get on to that was just this is just more to the point that this is the PSI. So basically, there's a PMI and there's a PSI. So, and that's actually a PCI as well for the Performance Construction Index. Okay. Every month there's one for the manufacturing index. This is the service sector. The headline number's below 50. When it's below 50, that means that the sector is broadly in contraction across. Now you notice that new orders are up, sales are down. I mean, it's a mixed bag. It's a reading of about, I think the reading was 48.9 or something like that. So it's not devastating, but it doesn't point to a particularly strong economy. I think what we see, and this is the tough part for the RBA, all the economic data seems to show, the economy's on the boil, low unemployment, high inflation, people are still spending fine. And this sort of goes to my next point. This was Dusk. I picked Dusk because Dusk is probably one of the most discretionary of discretionary retailers, right? It's scented candles and cushions, that sort of stuff. I mean, it's relatively low cost, and it's not like they're luxury items, but they are very discretionary. And they just had their AGM this week, or was it last week? And their sales are fine, gross margins are fine, they're happy with their inventory. Now they didn't give any guidance because for these types of retailers, and there's a lot of retailers like this, the period from now through to Christmas is about 6 weeks. That's 60. The first half accounts for what 70% of earnings for some of these companies, right? Because of the Christmas period, and they're not giving any guidance, but they're saying everything's fine. And this is what I've been saying for a few months, which is that I reckon Australia will have a strong Christmas, that everything will look good. And then it all starts to, when we get the hangover from Christmas and, it starts to look bad next year. So I just threw that in there. It's anecdotal, obviously, but yeah, this just adds to the conundrum. Things look strong, but I think under the surface there...
Well, that's very strong. Those total sales there are insane. Like, really. So...
Yeah. So, yeah, I mean, everything looks good. You look at that and you think... And it's just been the same with a lot of the discretionary retailers. I pulled this one out because it was only last week they had their AGM. Most of them have had their AGM last month. So I thought this one might be a little bit more up to date. The only thing you can say there is they're not giving guidance. But yeah, I think it's interesting. Yep. Sorry, I've gone too far. And just the other thing, of course, that it's not here, but I've just seen some more stories about. There was a story yesterday, I could have included it here, about the Dorrigo pub. You know where Dorrigo is? It's New South Wales, northern New South Wales.
Okay.
Pass. Yeah. So they've made a submission to the commission looking into renewable energy, and they've said that they listed all these measures that they did to reduce their electricity use. And so they put in, like where they had saloon doors, they put in closing doors so they don't have to use air conditioning as much. And they've put in air conditioners where previously they had heaters and things, and they're much more fuel efficient, blah, blah, blah. Anyway, their electricity contract's coming up for renewal, and it's going to go up much more than they anticipated. And the reason that the electricity supplier gave them was that because of the closure of the Liddell coal-fired power plant. That's why now, who knows if the electricity company is telling the truth? But again, it's just another shoe to drop with a lot of these companies. I may have mentioned snack brands the other week that's says they're going to see a tripling in their electricity bill in the next year, and that they won't be able to almost operate. They're going to have to pass on huge increases in their price of their food. So that's just another shoe that hasn't really dropped. And I think when we get into early next year, it's going to be a bit more havoc around.
Yeah,
any comments?
I've been looking at a few things. Like I'm in fertilizer, and I've seen phosphate has like gone up to 2008 levels. It's not far off that.
Right.
So that's because of the war in Ukraine. But
Yep.
all that happens is that just gets passed on to the consumer. Eventually, like the first 6 months, everyone absorbs it, and then they start passing it on, and then obviously once you increase fertilizer, then it flows onto food, and everybody in the cycle tax a little bit on, and then they think, oh, this is never ending, and they just keep adding on to the price, and then even if things go down, they just stick to those prices, and prices hardly ever go backwards. I rarely see people go, oh, like inflation's gone back down, let's go revert back to the old pricing.
No, I can see that in my own business. It's the prices on certain things have stopped going up, but they have definitely not reversed. It just we're at a new normal, aren't we? Which kind of plays into this next chart. So this came from AQR. These are quant guys, and I think you were surprised by this, and I was surprised by it as well. That if reverting to 3% inflation is easy from 4%, hard from 6%, and very hard from 8% or more, which, remember, I think the US topped out at 8.3 from memory. Above 8%, reverting to 3% usually takes 6 to 20 years, with the median of over 10. So, of course, we should not say, therefore, that it's going to take the US to go from 8 to 3, it's going to take 10 years. This could happen much quicker, particularly if next year, let's say the Fed goes nuts, they get to 6% Fed funds, and the economy craters. Yeah, you'll soon have you. But I think that, again, it's an argument for the stickiness of inflation, and that because a recency bias of a lot of people, you've got a whole generation of investors who don't even know what inflation is, don't even remember what it was like to get a return on a savings account. There's this recency bias that we're going to go back down to 2, and we're going to go back to happy days, and just maybe it's going to take a little bit longer.
Yeah, well, the war in Ukraine could, if that gets resolved, that may help bring it down a little bit quicker as well. But who says that's going to happen? You've got no crystal ball here. So, even if you take half that, instead of 10 years, 5 years, or even more generous, and you go, okay, 3 years. No one thinks that at the moment. The market clearly doesn't think anything like that. They're all talking next year. Like it's So
I think, what is the RBA saying, that they'll be at 4 by next, like a year from now, and then they'll be back to target. So they want to be back to target in 2 years. That's what the RBA is saying. Could take longer than that. Could take a lot longer than that. And therefore, stock markets don't have to go down. They can just go sideways.
Well, and then if the central banks lose patience and they decide, we've really got to start hiking here to get this under control, this is what I'm fearing is, it'll collapse the economy. If they do a big number here, they do 100 basis points or something like that, that'll just freak the market. And especially if it's next year.
And especially, you saw Lowe's comments about, a wage price spiral being a bad thing. He wants to head that off. That's not a good thing. So, I've seen data that suggests that that's not true, but Macro Business put something out yesterday saying basically that's not true. But because in periods of high inflation, actually wages went up even more than inflation. But you've got to play what the Reserve Bank is telling you they're going to do. So,
Yeah, I just think this chart is just devastating. Like, like when you look at it, you just think, wow, imagine going through this for another 2 to 3 years. That'll be
Yeah.
just insane. Like, you can see how the market would just not handle it. Like, because everyone's used to
Oh
gains.
no.
Like, it would be, you know,
Yep.
everybody in the last decade or even more is just used to having,
Yeah.
corrections, but it happens quite quickly. Well, just look at the COVID crash. 2 weeks. If you weren't involved in that, you basically
I know.
missed it.
I
So,
know.
yeah,
Yep. Yeah, I was just, back then I was like, yeah, I suppose I should get my shopping basket. Oh no,
too late.
back to New Hyde. Too late. Yeah.
Yeah. So, yeah, here you're going to have a bit of time to think about it, and then you're going to have some of these other companies are going to, obviously crash in this situation if you're got too much leverage going on, which I'll show you a couple of them later on. They've got good fundamentals, but obviously got heaps. The balance sheet looks terrible, so
Yeah.
you know. Mm.
Yeah. Yeah. Well, I mean, how much attention have people paid to debt in the last decade? Probably not a lot. I mean, if you're Howard Marks, you probably have been because
Yes.
that's his job. But a lot of people haven't given a shit about debt. Oh, all of a sudden you have to pay 6-8% on your debt. My God.
Well, even I do. I'll just look at the current ratio, which is
Mm,
current liabilities, like so.
yeah.
I'm not even really looking at total debt, and
Mm,
it's built into me. I understand that, I've just ignored it because it has no
yep.
effect.
Yeah.
You'd be fooled to think, oh, look at the balance sheet, isn't that terrible? Like, and you got the Japanese an example. Like, they've got great balance sheets, heaps of cash in the books and everything like that, and they go nowhere.
Mm,
And you look
yeah.
at all the highly leveraged companies and heaps of growth, and
Yeah.
yes,
Well, there's probably a signal in there. It's probably that what worked in the last 10 years is not going to work in the next 10.
yeah.
Yeah. But
Mhm.
all right. Well, let's get to this stuff. Do you want to take us through this one?
Yeah, so I'm on this quality trip, trying to work out, because I'm trying to find, who actually gets alpha in the market over a long
Mm,
period of time, over multiple cycles. Um, and I've fallen victim to this myself, thinking, I'll pick a company that's cheap, revert to being, a higher
yep.
multiple later, and buy at a discount, and wait, be patient and wait for the market to turn around. But as you can see from these things, buying a high quality business, which is cash return on cash invested,
Yep.
sort of like return on invested capital that I use, but why they use this is Goldman doing this is because it can go
Yep.
across multiple sectors. So the problem with using return on invested capital is people know that insurance companies and banks look horrendous because they've got all this capital, and
Mm,
really you shouldn't be. So this is what they're trying to do it across multiple sectors. So they're using this metric, which I don't really like. But as you can see from this sort of thing, these high numbers, it stays sticky. It's very sticky. So if you're really good at allocating and getting high returns in your business, it stays, it's not as market in returning to the mean as you think, because you think,
So
oh, compared.
what are we looking at? I don't actually understand this chart. What is the bottom saying, that 95, 90, 90, 85? What's that about?
So we set up these limits on when to purchase a company and when to sell a company. So
Yep.
this is in the 95 to 90 sort of range. On the left-hand side of the chart here, there when we purchased companies that had these high returns on cash invested,
Yeah.
basically. And as you can see, and the annualized return correlates to that.
Right.
And standard deviation there is like just the error factor going into that.
Yep.
You can see that it covers it quite well. So when you've got a company that can't reinvest very well, down that 55 to 50 range,
Yep.
annual return gets hurt here really hard. So we've got this thing, because we understand economics, reversion to the mean, that we think, a quality company can't hold this moat for too long. But capitalism,
But it can.
but it can. And so what we do is we chase these low these low return companies trying to get outsized performance alpha.
Yep.
When we should be sticking to quality and sticking to it and just riding it. And momentum is one of these factors that we don't really take into account. That is a factor. And as you can see, it works. And I've been looking up all these funds, and over the long period, these are the guys who actually get consistent alpha. Unless you're brilliant, like Warren Buffett or, a couple of the other guys who, can play cycles and all this.
Yep.
For us mere mortals, we should be sticking to quality. And instead of diving down to the bottom end of the market, bottom fishing is what I call it. And so I'm trying to be less of a hero and trying to actually bring some discipline to my life instead of trying to look at these outsized returns and thinking and buying quality. But still...
Really, the challenge here is not identifying it, but the challenge here is getting in the mindset of paying up for it.
Yes.
Right. Paying up for this quality, because you're like, oh, but it's trading on 28 times, PepsiCo or whatever. Yeah, it doesn't matter.
Yep.
If you'd have bought it at 28 times, you still would have got a great return, or a well above market average return. So that's the bit that I find the toughest as well. Like that paying, geez, this is not this is expensive based on an average market multiple. Yeah, well, this is not an average company. This is an exceptional company, and that's why you pay up for it. Yeah.
And it's very hard for you to do as a value type person, because you're trying to price is what you pay, and the value is what you get. This has been drilled into you over and over and over. And you've been through so many crashes that you think, it'll come back to a 15 multiple, to the average or underneath that in a crash. So you think, how could, in a crash, these are going to look very ugly. So the next slide shows it as well. It's like a little bit, it's the same sort of thing, So this is the stocks that stay in that range, that 95 to that high, return on cash employed, invested.
Yeah.
So you see these random ones, it's all over the place. But if you can see, even the second year, they stay basically correlated. So all these people who go and like, Apple, what a great company it is. Oh, yeah, I know about it. It's earned really good returns. How good it's trucking along. I should invest in it. And this is what the small investor thinks. But, us big brain people think, look, that's too high a price to be paying for that. We'll go look for this little diamond underneath the rocks. We'll go search.
Yeah. The thing that nobody else can see. And I'm a genius because I've found it.
Yeah. This is the dumbass mindset that we have. And you can see here, it burns us. Like, we really should be sticking, Apple is a quality company. It's fairly well established here, and it's getting high returns on capital employed. We should be applying to, even though if it's a high multiple, it's justified, better than buying junk with low multiple, aka Iron Man. Like all these people who think, buying low multiple and wait for the multiple to re-rate. That's not where value is created. Value is created from the capital being reemployed. Yeah.
That's actually not. I don't have a problem of buying. I got over the problem of buying junk a long time ago. That's not my problem. My problem is I do want to buy the quality, but the quality never gets to the price that I want to pay for it, right? And so you end up buying nothing.
Yes.
And you end up, missing out on returns over time. I do not have a Captain Save a Dog mentality. I don't need to rescue companies that are maybe on the turnaround. I've gotten rid of that. My problem is actually paying up for the ones that are worth paying for. That's my
well. How much
challenge.
should you pay for quality? And the problem is we've got this thing is, will this quality stay? And you can see reversion to the mean doesn't happen as quickly. All these people saying inflation is going to come down. In the next couple of months. All these people. Things take a lot longer than what we think happens. So when
people have been saying that about profit margins for going on 15 years. They're going to revert. They're the most mean reverting series in economics, and they have taken a while.
Yeah.
Mm.
Yeah, so that's what I'm trying to understand here. Like, you should be picking a winning horse and staying with that winning horse, but just being a little bit smarter about it.
Yeah.
Has that winning horse got longevity? Yeah, so I'm not sure. Yeah, so I'll put an example up next on the next slide. Um, so
FDS,
yeah, so it's
FactSet.
yeah, so this is a bit of a weird company for me to be because I'm don't understand it too well. But it's just an example of, just look at this price to earnings ratio, 43. So
Mm-hmm.
this is the world of pain for me because I'll be like, wow, when this reverts, um, to a 20 or whatever, like you're going to be in all sorts of pain here because that's going to take 5 to 10 years to you know, to come back. But yeah, you looked at this price of free cash flow, it's only 29.
Mm.
So it's not too crazy here. And you look at these return on invested capital, it's a bit low this year. Got some stuff on the capital side that they made an acquisition. So a big
Right.
acquisition, so it makes it look terrible this year.
Yep.
But generally, you look at those numbers, you're 48, 26, 23, 30, 24.
Yep.
I did put
Return
up,
on equity too is excellent. Mm.
yep. So, what point here can you go, hey, am I going to be buying this PE of 43? Or that's why I keep hoping for a correction here, something that'll
Mm.
come down into the 30s or even the 20s. And you think, okay, this will hold up over the long term. It's only
Yep.
competing against Bloomberg and a couple other data companies that are. So I think, oh, maybe this is a bit of a moat, but it's a bit complex for me to understand. But
Mm.
like, I've got the same disease. Like,
Yeah.
I can't pay for quality. It just looks so
Yeah.
crazy. That's all. So trying to grow up a little bit here and trying to surround myself with. Like, I've read all of Terry Smith's notes now. Through doing his annual letters now through the second and third ones. I'm seeing price to free cash flow, really changed now. It used to be back in 2010, it was like you get a free cash flow yield of 7%. Then it's
Right.
gone to 5, then 4, now it's
Four.
3, now it's, 2. And so, but even Terry Smith has sort of gone, I'm going to keep purchasing around the edges here, but I don't know. What do you think? Like, is it possible for me to change my ways here? Like, is it possible to
Yeah.
give?
Well, see, unfortunately, maybe the thing that'll change your ways is you actually buy one and hold it for 5 years and it works, and you go, yeah, maybe, and maybe I should have bought a lot more of those types of companies 5 years ago. I
Yeah,
don't
yeah,
know, but I mean, there's enough evidence out there that it works, and you don't have to go past any more people than Terry Smith and Warren Buffett to
yes.
see it, or Berkshire, if you like, to see that it works. So the breaking the psychological barrier to
Mm.
pulling the trigger, that's the toughest bit. I mean, I still see, we talk about macro a bit, and I think we've sort of spelled out the risks to the macro environment, and in earnings in particular, that
Yes.
means
Having.
that the stock market can still go lower, but it's probably not wise to bank on that outcome before purchasing some of these stocks.
Yeah.
Because if you purchase something that's really high quality and it drops 20% because the S&P does go to 3,200
Mm-hmm.
sometime early next year, does it matter?
No, not really.
You got to be comfortable with that drawdown, because you got to look at the stock and go, well, it's a quality stock. Nothing's changed fundamentally. The market's just sold off.
Yep.
If anything, I should just buy more and add to the position. Easier said than done.
Yes. Yeah, yeah. So I don't know. I'm trying to get my head around it. I see a couple other funds around the world have had the long-term game. So it's not just Terry Smith. This formula does work. I'm seeing it over
Yeah.
and over, where they can handle a down cycle and they come out the other side. It just looks, just even Terry Smith recommends now that it's a terrible time for him because he's got all these high multiple products, these stocks, and he knows they're going to get re-rated here.
Yeah.
And he knows he's going to cop a bit of a flogging for a year or two, and then they'll push through it. So I'm thinking, am I being greedy here, just waiting for that to happen? Like, I think that we're going to get a little bit more. I know the earnings thing is still to come, but will the market look through that and look through to 2024, 2025, when things are a little bit rosier? So
yeah, exactly. I mean, if there's no major market correction in the first half of the year and the earnings downturn is, it's 20%, which is significant, but not. And then people start, it's June and people start going, well, 24 is going to be a recovery.
Yep.
So, and then we're off and away again and you've missed your opportunity. So
that's right.
And, you might not get your 40 VIX.
Yes, at all. Yes. But the only thing as well, I want to keep some dry powder, and it might be, once in a lifetime opportunity. And I already own stocks. So, it goes sideways or down or up, I'll be happy, even the China thing's looking good for me now, no one was negative about China anymore. You notice that? Like Biden's been over there,
Howard Marks changed pretty quick.
Howard Marks coming saying uninvestable. Oh, that sounds interesting. And everyone's gone, well, with Howard saying, it could be a possibility here. Maybe we have overblown this a little bit.
Well, that's the thing with it. It's kind of a recency bias too, because, China's been shut down effectively for COVID, for all, and we start to take that for granted. And then all of a sudden it opens up again. And like, oh, wow, off to the races again. That's one thing. That's one more thing you can just discount now. Ukraine war would be another one. We get too used to the environment being what it is. Well, it looks like I got to get going, go out and buy some stocks after this chat. I got to get off this. I've just convinced myself it's all in.
You should be always looking. And like last week, we talked about what crashed really bad was the crypto market, and I stepped in there a little bit and bought some craziness, really out there on the risk curve, so. I don't know. Well, from all this, I'm reading.
We could have a chat about maybe next week. Worth having a chat about crypto, because it's held in there really well. And I think the narrative that, because it's so easy to throw the baby out the bathwater with crypto, and yet the thing that you said, and the clip you sent me about, look, the whole point of crypto is so you don't have to trust third parties like Sam Bankman-Fried. The whole point of it is to trust maths, blockchain, the whole cryptography. And so, I don't know. My struggle, as you know, is trying to determine what it's actually worth.
And like gold, but the problem with this sell-off is, like a whole heap of gold exchanges have gone under as well. Like been frauds, they've been, don't have the capital, and they've been, basically a Ponzi scheme. But when they crash, gold doesn't crater, when the exchange is found out to be fraud. But this is such a, new industry that everyone, thinks, oh, Bitcoin must be terrible now, because some dudes are ficking fraud, So clearly isn't the case. But very interesting to really hash it out. I think there is value in this area. It's just hard to see it. That's all, from a value type traditional investment. And I agree with 95% of the people that attack it.